Good morning, everyone. My name is Eloise Hall, Head of National Accounts here at Kensington Mortgages, and a huge warm welcome to our latest webinar, Money Myths, What Today's Profiles Don't Always Show. I've seen lots of familiar names registered to join us this morning, so a huge thank you to all of you for your continued support. I've also seen some new names joining us this morning, so if this is your first webinar with Kensington, I create these webinars on the back of your feedback, bringing to life and sharing with you the latest industry insights and ideas to support you and your business with growth and knowledge. Like much of what we do at Kensington, we dare to be different, and today is no different. You will be hearing from some potentially unfamiliar names, but experts in their areas, sharing their thoughts on our ways to grow and succeed in current mortgage landscape. This morning, we are looking at money myths and how to support customers with their credit files. But before we get into the full agenda of the day, I personally think it's a great one as well, I'll just run through some brief housekeeping tips for you. You've got the option to submit questions throughout our session today, and my expert colleague Adam will be working behind the scenes to either answer those for you or put them to our panelists. If you do have any tech issues, then please do use the same question box and we will be on hand to help. I'll also be running some poll questions throughout today's webinar, so keep your fingers at the ready to join in on the voting. We are expecting to run to around 45 minutes this morning, and your CPD certificates will reflect this. They will be emailed out to you after today's session, so keep an eye on your inbox for those. But to make sure I keep to time, let's get started with the day. As I mentioned, we've got a great lineup planned for you. First up, I will be joined by Ed Levers, Partnership Development Manager at PayPlan, and Ed will be discussing PayPlan's insights into money myths and highlighting ways to support your customers with new tips and tools. Next up, I'll be joined by Martin Smith, Head of Consulting at Equifax, who will be highlighting the market trends impacting consumer borrowing and expenditure. And lastly, I'll be welcoming Jane Atkins, Kensington's Head of Intermediary Sales, to give us the latest Kensington business updates. So before I welcome Ed onto screen, I want to share our very first poll question. So you should see it on screen now. So you should see a question where I'm asking, when advising your clients on mortgage readiness, which of these do you find the customer most often overlooks? This can be for any of your clients, whether it's first-time buyers, home movers, or even landlord customers. What do you find is most often overlooked by these customers from their point of view? Is it maintaining and managing credit card or even debt arrears and their repayments? Is it pre-checking their credit files? Or is it updating their electoral roll or address histories accurately? We did run this poll on LinkedIn, so thank you to all of those who voted in that. But I would also love to get your input this morning as well. I'll share the LinkedIn results along with the results from this live poll with you after our next presenter, which will be Ed from PayPlan. For those of you that haven't heard the name PayPlan before, PayPlan offer free, simple debt advice to anyone who needs it. They were created back in 1992 and have supported over 1 million people to become debt-free. I'll reveal the answers to this poll after Ed's presentation. So I'll give you just now a matter of a few seconds more left to vote in this poll, and then I'll close it down and reveal the answers later. Excellent. Thank you so much to those of you that have voted. So I'd now like to welcome Ed Levers, Partnership Development Manager from PayPlan. Over to you now, Ed.
Thank you, Eloise. Good morning, everyone. My name is Ed Levers from PayPlan, and I'm really excited today to join Kensington Mortgages webinar to share with you what we do at PayPlan and how we support customers that might be experiencing a level of financial difficulty that's really getting in the way of you being able to support them with their mortgage application. Wanted to start by giving you a bit of guidance about what we've seen in terms of demand and some of the trends that we've seen over the last couple of years. It's boom time in terms of demand for debt advice. We're seeing this across the sector, and you can see that over the last 5 years, there's been a steady growth in the amount of customers reaching out, experiencing financial difficulty and reaching out for help and guidance. In fact, we saw a record number of customers last year, and we're on track to exceed that once again this year. What's driving that kind of demand? Well, two things really. One are economic factors. Starting with the COVID pandemic, of course, which caused all kinds of financial difficulty to customers. More recently, the cost of living crisis, where a general rise in a number of different areas across the economy has really dragged additional customers into a level of difficulty that they weren't expecting. On top of that, the FCA's consumer duty regulations has put a much greater onus on the financial service industry to support customers, to actually ensure that those customers are getting the help and guidance that they need to be able to reach their financial aspirations. And that means more of those customers are being referred through to help earlier in the process. What we are seeing, as you can see, is we're seeing a far greater number of more affluent customers experiencing a level of pinch with their finances. 2 years ago, maybe 1 in 20, less than 5% of the customers, where they had a combined household income of £65,000 or more, would have experienced financial difficulty and reached out to us for help. That's tripled over the last couple of years, and that's substantially customers where they've been living right to the top of their means, and where the cost of borrowing has increased. It puts them into a situation where their numbers don't add up anymore. And that can be really stressful and really surprising for the customers that happens to. What have we seen in terms of other growth areas? Well, a huge increase in the number of customers running small businesses, whether they're sole traders, limited companies or partnerships, as well as an increased demand for customers wanting to engage with us on a digital format, online, WhatsApp, live chat, etc. Being very, very popular and seeing a huge increase in the demand in those areas. Next slide, please. So I referenced already the cost of living crisis, but I think it's worth shining a light on some of the trends that come from within that. At PayPlan, with regard to the cohort of customers that we support, typically with much lower income and outgoings than the typical mortgage application customer that you will see, we see an increase year on year from the thousands of income and expenditure reviews that we complete each month. About £150 per month being spent, increased by each customer that we see. Of course, many of the customers, it's hundreds of pounds more per month outgoings than they'd budgeted for or that they've been spending just a year or so ago. 60% of this increase is derived back to increases in home energy and accommodation costs, whether it's their mortgage or their rent costs. Probably no surprise there, since the cost of energy is at record levels, even though the summer coming up, we're going to see a slight decrease in the government cap. What we have seen as a byproduct to this increase in demand is the number of customers that have fallen behind on priority payments, whether it's utilities, council tax, or their accommodation costs. Actually, we're running at 2 in 5 customers currently falling behind on those kind of priority payments. You might be expecting that to be pretty high given the work that we do with customers in financial difficulty, but that has roughly doubled in the last 2 years. And things like inflation, although it feels like it's under control with current figures around 3.5% inflation rate, certainly not the high levels that we saw at the back end of 2022 and 2023, where there were double-digit inflation rates. Food, for example. The actual price of food is roughly a third higher than it was 2 years ago. That's almost like an indirect tax and creates a lot of problems where customers are already pretty tight on things, really struggling to cover all of the basics. But without doubt, when I'm talking to mortgage brokers like yourselves, the biggest factor to consider is the Bank of England base rate. If you take a 12 to 15-year view, and we've seen a very, very long period of low interest rates on mortgage, suddenly a jump up to where it is now at 4.25%, It's a bit of a shock to the system. What that typically means is customers, when they're coming off the end of a fixed rate, looking to remortgage or indeed enter the housing market, either as a fast-time buyer or as a home mover, they're getting a real shock when they actually then do the maths in terms of what the cost of their new mortgage will be. And of course, that directly impacts their affordability. Typically, on the average size mortgage of around £170,000 per year, the impact of that is about £200 a month. On larger mortgages, often that's much, much higher. And in the buy-to-let sector, typically we're seeing customers having to make really difficult decisions about the size of their portfolio, given how big an impact they're seeing. So typically, we're finding customers are faced with impossible choices on what not to pay. Keeping a roof over your head, heating and lighting your home, or putting the food on the table are often very real choices that customers are pitched into. Next slide, please. When we're supporting customers, we're very, very aware that we need to support our financial services partners and customers as early as possible in the process. Historically, at PayPlan, we've always been able to help customers when things go wrong, helping them repay their debt in an organised and structured way, completely free of charge, through things like debt management plans and accessing formal insolvencies where that's appropriate. Many of the challenges that I've just been talking to you about come from customers that aren't really ripe candidates for that kind of structured debt solution. They do need guidance and help earlier in the process. We've been working often with banks on pre-arrears strategies where customers might not be missing payments yet, but it's clear that they're becoming irregular in the timing of their payments, or they might be missing payments elsewhere across their whole portfolio of credit. What does that really mean? Well, it means the more that we can educate, support customers, help them make those difficult choices around cutting their costs according to their new circumstances, helping them with things like income maximisation and shopping around where appropriate. Often that can stabilise their financial health and well-being and avoid them slipping into a situation where they're going to fail a credit check, miss an acceptance in principle, or if that has happened to one of your customers, help them rehabilitate their finances in a short period of time. It's often a really difficult ask to get a customer to think proactively about their financial health and well-being. But the more that we do, and the more that we get traction in that, it works really, really well. And in fact, we use our Budget Smart logo to avoid the connotations that might be linked to PayPlan as a brand built up over 30 years of supporting customers in the UK. So what is Budget Smart? Next slide. Your customers can access Budget Smart via the Kensington Mortgages website. We're within the financial difficulties page, and it's a fantastic knowledge resource, completely free to use, not included with any passwords, and therefore customers can access it anonymously. They can go back in bite-sized chunks and consume information in a way that's going to work for them. It gives them guidance on how to reduce their outgoings, shop around. It gives them information on benefits, grants, and other ways they can boost their income. It really gives them guidance on how to stabilise their finances. Customers find Budget Smart really easy to use, as you can see from the survey on screen. And for 3/4 of those customers, it really helped them take control and get rid of their financial worries. 30% of customers make savings, and actually nearly 60% of customers identify areas where they can actually reduce their expenditure. And in fact, 7 out of 10 customers end up saying it's really helped them feel more confident or very confident about managing their finances moving forward. Most customers access it on a phone, and it becomes a really easy way of getting extra information. It's basically a goldmine of information for those customers that want to seize back control of their finances and get themselves into a situation where they might improve their credit score, increase their affordability, and actually just get more disposable income to be in a situation where they feel more in control of their finances. Next slide. When talking about the work that we do at PayPlan to support customers experiencing financial difficulty, I think it would be remiss of me to not talk about vulnerability, because in fact, all of the customers we speak to are experiencing financial challenges, but over half of them will disclose additional vulnerabilities over and above that, whether it's to do with mental health, bereavement, serious ill health, or addiction issues. There's all kinds of challenges which customers share with us. And because we're not a lender or indeed are completely independent and confidential, we find that more than 9 out of 10 customers will share very openly and voluntarily the information that they've got about their vulnerabilities. Why would they do that? Well, whilst we're focusing our expertise and knowledge to help them get back on track with regard to making payments across all of their credit commitments, that enables us to access all of our network of partners who are specialists across all those different areas of vulnerability, many charities and specialist organisations that have got expert guidance and help to support those customers get the support and help they need. You can see just a small example there of the 65 plus different organisations that we work with that are able to help customers and their families respond to the challenges that they have in their life. So in summary, on the final slide, I thought we'd finish on some customer feedback that we receive at PayPlan. Because true, many of the customers that we're helping have been struggling with their finances for many years. But we are also now seeing many customers that have just started to run into difficulty, maybe due to a change in their personal circumstances or to do with the financial impacts that I've talked about a little bit earlier in this session. For those customers, suddenly it's a huge weight off their mind, the fact that we're able to help them get back on top of their finances, start making regular payments across all of their different credit commitments. And it's not just in terms of their getting on top of their finances. For many customers, it's a transformative impact on their mental well-being and certainly their financial health. And that constant nagging worry that their finances aren't fully under control. That's a real legacy of the work that we do, helping customers get back in control of their finances.
Wonderful. Thank you so much for sharing that presentation, Ed. It was fantastic. Some really interesting data points there. And in fact, one of the ones that really resonated with me and in fact somebody from the audience today was the number of increasing affluent customers that require support. The question they've kind of posed is, why do you think that is? Why are there more affluent customers that are needing support at the moment?
I think there's a couple of things going on there. One is that we are seeing customers more readily willing to talk about their finances and open up. And whether it be their bank, their mortgage provider, sometimes their credit card company, more willing to access help earlier in the process. Rather than waiting until they're horribly out of control, they're recognising that the numbers don't really add up and their situation isn't really improving despite some belt tightening moves that they've made. And therefore, they're willing to come through and look for our guidance earlier in the process. I think the impact of the borrowing rates has a big impact on this though, because what we're seeing is customers where they've been able to borrow up to the lifestyle that they were able to earn. And it doesn't necessarily mean they've had a huge drop in their overall income, but because the cost of borrowing is so much higher, actually, if you've lived to the max to enjoy standard of living that goes with the hard work that they put into their life, suddenly the numbers have changed quite dramatically in a short space of time. And those customers often realise I can move things around a bit, but fundamentally something's got to change, and therefore recognise that they do need that extra bit of help.
No, absolutely. And I think brokers at the moment are presented with very two polar opposites. They've got customers coming up for 5-year renewals that are previously on a very low rate, experiencing that hit and really having to have those conversations. But also then the difference of customers that have either been on a 2-year fix and are now looking at a slightly cheaper rate, or potentially moving from a specialist to a high street if they've had the right support in that period of time for their credit. So really interesting time and challenging time for brokers navigating those different customer needs. I suppose from your perspective as well, is there any other recent trends that have surprised you and your business in the current market lately?
I think the ever increasing march of requiring online support is very, very interesting to see, because and it's, you know, sometimes when we support customers on WhatsApp, so we don't do digital advice. It is all handmade advice with expert debt advisors. actually, coming through on WhatsApp, sharing information with us via that route. They might eventually talk to us over the phone, but only once we've gained their trust. And actually seeing that in the 5 years that I've worked with PayPlan, it's very, very clear that that's been an increasing trend and continues to be. Customers are much more comfortable to share information via that route than historically they would have been quite cautious about doing. And it's being aware that that route is very valid route. And when I've been talking about things like a budget smart tool, where rather than talking to an expert advisor, sometimes customers are quite happy to start their journey by having a look at the content that's there and then reaching out to us when they need a bit more guidance. So yeah, definitely an emerging trend.
No, absolutely. I can completely agree that I suppose having the anonymity to be able to have free and open conversations can be really kind of supportive, and using digital to utilize that is key. We did explore in the last webinar we ran actually around Gen Z and how a lot of the younger demographics are reaching out to different types of technology to support them in their home ownership and absolutely evidently their credit kind of score journeys as well. I suppose with you mentioning the Budget Smart tool, I will mention to the brokers listening today as well. We will send out a link to where that's hosted on Kensington's website in the follow-up email as well. So please do head over to that and have a look. It's a fantastic tool. I suppose last question for me then, Ed. With an increased focus around consumer duty and lots of regulatory pressures and vulnerability, what would be your top tip for mortgage brokers that are listening today to help them navigate the complex landscape they find themselves in?
Yeah, really good question, because I think reassuring customers to reach out and get guidance early is super important. What historically happens is that customers are really bearish about sharing information during an application process where they think it might impact affordability. And then if they do get a challenge around either max affordability or on the acceptance in principle, customers, it's an opportunity really to improve their financial health, to do something about it before it gets out of shape, and therefore reaching out to us and to others to take proactive action to be able to save money on different things that they spend money on in terms of credit commitments. Make some changes, get into some good habits that's going to make a huge difference. Don't wait for things to get out of shape, and certainly don't have that fear factor that speaking to someone is going to kill your credit score, because it's certainly not. There's all kinds of things that we can do and guide them on that don't actually impact that at all. And it's better to do that before you start missing payments and getting to defaults and all the things that happen later down the road. So spotting it early and taking action is super important. These are going to be,
thank you so much.
Yeah, I was just going to say, these are going to be the customers that will come back to you in 6 months if they fail affordability or they get a decline. Actually, they'll sort their house out and they'll come back to the same broker if you have that brave conversation to guide them through on what they need to do next.
Absolutely, and definitely within the specialist space, what we find is customers that are well supported by their broker, and that broker helps them through getting whatever their mortgage journey looks like and supports them with that, are returning customers, are customers that will leave you 5-star reviews, help you grow your business by referring you to friends and family. So they are absolutely like magnets. So really, really worthwhile getting these tools under the belt. But thank you so much for your time and for answering my questions, Ed. Really appreciate you joining us this morning.
Thanks, Eloise.
Brilliant. So I would now love to share the results of the poll that I ran just before Ed's presentation. I asked you this question. So when advising your clients on mortgage readiness, which of these do you find the customer most often overlooks? And I can see from the results that 21% of you said that credit or debt repayments are the most often overlooked area, and a whopping 57% of you said customers most often overlook pre-checking their credit files, and 18% of you said that in fact customers most often overlook updating their address histories or electoral roll data, and 4% said other. So I'd be interested if you could put your other answers in the question box and give us that insight. When comparing this to our LinkedIn results, it was 17% voted for credit repayments, 50% voted for pre-checking credit files, and 33% on updating their address or electoral roll data, which is very interesting. So some similar correlations there actually, and great to have that comparison. So thank you to all of you who voted in that. I hope our next session will give further insight into this data for you. So our next expert guest is Martin Smith, Head of Consultancy at Equifax. So please let me welcome you onto screen now, Martin. Over to you.
So thanks, Eloise. What I'm going to go through today is just a bit of an overview of some of the kind of borrowing and expenditure trends we're seeing here at Equifax, and really kind of looking at how credit and transaction data looks in a kind of changing mortgage market. So as we know, we've all sort of been through a cost of living crisis the last few years. And if we think back to sort of the end of 2023, what we were seeing back then was kind of like a higher cost of living. So everybody was kind of facing higher prices. Inflation was starting to level off at that stage. Prices were still rising faster than wages. Also, we'd seen kind of rises in interest rates, and we're still living with that today. So rates had hit a kind of historical high following some market turmoil. And the result of that was mortgage shock. So mortgage borrowers were coming off long-term, low-rate fixed mortgages and trackers, and they were finding that the market was offering products that were vastly more expensive than the ones they were used to. And at the same time that all of this stuff is happening, then we have kind of the utility prices rising, partly as a result of the war in Ukraine and for other market reasons as well. So consumers were being kind of hammered on multiple fronts. So if we take a look at what's been happening in the mortgage market since that time, and really it's it's a story of slow recovery. So in 2023, we'd seen a huge drop-off in the kind of number of mortgage originations. And then throughout 2024, we saw a slow recovery. So we saw about 4.1% of mortgages coming back following that big dip in 2023. So quite a substantial drop in demand for mortgages at that point. And as we know, because of those rate changes, repayments kind of remain high. And so overall, at the moment, average mortgage repayments are about £221 higher than they were back in 2022. And for new mortgage customers, repayments on average are 58% higher than when Liz trusted her famous budget. So the way that consumers have kind of handled this is to really kind of change some of their behaviours. And one of those behaviours is in mortgage terms. Consumers are kind of typically taking mortgages over a longer period of time. So today, 30% of new mortgages have terms of over 30 years. And consequently, we're seeing a rise of lending into retirement, people who are kind of borrowing beyond the traditional kind of retirement ages of sort of 67 years old. Now, that's not to say that all consumers will borrow into retirement, but it does mean that they're sort of taking a financial commitment over a longer period as a means of kind of coping with the higher cost that mortgages now represent. Looking at mortgage arrears, so missed payments, what we saw again as a result of those kind of rate rises is that we saw quite a big increase in the kind of number of people missing payments on a mortgage in the first few months of 2023 and into 2024. The good news is that arrears kind of behaviour peaked during 2024 and is now falling. But what was driving most of that arrears was actually older borrowers, so people 56 years and above. And those people were kind of, I guess, a bit less able to kind of mitigate the mortgage increases by borrowing for a longer period of time. So it's very often those people who are unable to find a new product to move to. So if we look outside of the mortgage world and into kind of broader unsecured lending, we see a kind of changing picture there as well. And so if you think back to the pandemic, people were really kind of saving a lot of money, they were paying off credit cards. And what's happened in the last couple of years is that credit card growth has continued to come back. It's come back very strongly. And in 2024, we saw 18% growth in new card openings and a 17% increase in the number of credit limit increases as well. So big sort of surge in demand really for credit cards. What that looks like is total credit card debt now exceeding 70 billion. That's sort of historically quite a big figure, but it's not sort of troublesome economically. We see that credit card debt's about 4.5% higher than it was during the pandemic. If you recall, I said that during the pandemic we sort of saw big big sort of declines in credit card debt as well. So it's up further, it's up compared to where it was, but it's not sort of significantly or worryingly high. So people are kind of using credit cards again. The other thing they're doing more and more is using buy now, pay later. Now, this is particularly a form of credit that's a bit more difficult to get on a credit report. These products are shared, but they're not sort of necessarily shared in their entirety by the companies that run these products. But nevertheless, for buy now, pay later, we see kind of a rising popularity of these. So around about 36% of consumers have used one of these products in the last couple of years. About 25% of people have transactions in any given month. And typically what they're spending on it is around about £66 a month, a little bit up from where it was the year before last. But yeah, that's the kind of typically what we're seeing on buy now, pay later. So with these kind of, I guess, the sort of cost of living crisis and also the changes in kind of mortgage repayment costs and so on, it's worth looking at how consumers navigated that change. And the way we do this is by looking at real customer spend. And in our case, we can look at this through transactional data from open banking. So what we've done in the next couple of slides is taking a look at what people have spent on grocery shopping over a 2-year period. Again, this is something that wouldn't appear in a credit report, but it does appear through open banking. And what we've done is compared what people spend on average with ONS, Office for National Statistics estimates, and then adjusted those for inflation. But this is an approach which is widely used by lenders to kind of estimate what people need to spend. And then what we've done is compared that for different income groups as well. And what we see is that for people in the kind of lowest income groups, so in this case, the second lowest income decile, the second lowest 10% group of consumers in terms of income, they were kind of immediately impacted by food inflation. So when we saw, food inflation in the shops hitting 10, 11, 12%, these people, their expenditure went up in line with ONS, or in line with inflation. And so ONS did a really good job of predicting what would happen to spend for that group of people. But if you look at middle earners, what they did, the dotted line here shows the kind of rise in inflation for ONS food expenditure. What these people were doing was kind of constraining what they spent. They were mitigating the effects of inflation in a way that lower earners were unable to do. So in this case, ONS fails to kind of pick up on that behavioural change. And what we can see from transaction data is that consumers were kind of trading down their supermarket. Okay, so they're buying cheaper products, they were buying own brands a bit more, and our share of wallet analysis allows us to see who those kind of winners and losers are. So looking at primary supermarkets, so who do you spend with most frequently? During this period, it was Aldi and Lidl, unsurprisingly, who kind of gained the most market share of primary supermarket. Sainsbury's and Asda were both down by about 0.6, 1.2% overall. And then the slight surprise for me is that Waitrose went down, which you might have expected. M&S food went up. So M&S was kind of a sort of net beneficiary during the cost of living crisis. I think because they had a focus on some of the kind of core staple food products as well during that time. So it's kind of gives you a kind of interesting angle on how the use of transactional data can tell a different story from what some of the assumptions might otherwise be. So that brings us on to how lenders assess affordability and how that's changing as well. So if we think about some of the typical approaches that lenders take when they're assessing income and affordability and expenditure, they tend to look at 4 things. So the first of them is bureau data. So they'll look at a credit reference agency and look for credit commitments, for rent, for mortgage payments, utility payments, and so on. Then they'll look to income to verify income. And to do that, they typically use current account turnover, which is information supplied by current account providers, and increasingly payroll data, HMRC data as well. And then there's kind of what I've termed self-declared information. So this is what customers tell you about what they spend, or what they share with you through something like open banking or the uploading of bank statements. So those are the kind of 3 sort of sources of information that lenders will use. And any gaps they tend to plug with these kind of income assessments or assumptions from sources like Office for National Statistics. Now, as we've seen, some of the limitations of those model views can be that inflation is experienced differently by different customers, by different consumer groups, but also in different categories. So the expenditure that you see, or the inflation you see on groceries is sometimes experienced differently from what you would see on gas bills and so on. So consumers react differently, and also the real world experience of inflation is different for different consumer groups as well. So what we're seeing is that lenders are taking a much more granular approach to assessing expenditure, and in the way that they assess, that they make assessments of kind of assumptions of spend. They're also starting to look at a lot more granular detail of what the transaction data can tell them. So to give you a sense of what open banking can do for a lender, it really kind of gives you a lot more information than a traditional credit score or traditional credit file would do. So using the transactional data, we can work out where does somebody work, so that we know that someone's employed by a local estate agent, for example, who's been there for 12 months, because we can see recurring transactions from a particular salary. We can see what the salary is, and we know it's salary because it says so in the transactions. And we can identify things that, again, are not visible to the credit report. So things like, are you paying your council tax? Are you up to date on insurance costs? And so on. As well as in there, there's some additional behavioural things like, do you gamble, do you withdraw, lots of cash, all these things that might be kind of viewed differently by different lenders. So it gives a really kind of rich, granular view. And increasingly, lenders are kind of looking at this data and thinking of ways that they can help customers get over the line and help them sort of successfully take out that mortgage application. I mentioned another source as well. Increasingly, we're seeing customers use, or clients use payroll data and HMRC data as well. So we have a couple of sources for this, which gives us roughly 50% coverage of payroll and 100% coverage of HMRC, assuming those customers can access their gateway. So a couple of extra sources that lenders are starting to use there. So as we've seen, I think that the way that lenders are using data is starting to change. And so it means that when customers are thinking about how do I sort of get myself ready for that mortgage, there's a few sort of hints and tips that we can share with them. So a few things I've sort of thought up here. So the first bit of advice I'd have for mortgage applicants will be about keeping credit repayments up to date, but also registered to your current address. And make sure you're on the electoral roll, because that's a kind of key source of identity information. I think also, using credit's usually a good thing. So if you've got a credit card, if you've got a personal loan or something, it's good to have those products, but you should always stay within your limits. Don't go mad with what you borrow, and keep your balance reasonably low. I think also a good practice is to monitor your credit report and score. There's lots of different services you can get these from. You can get them from Equifax, but there's other providers out there where you can go and see exactly what data is held and what your credit score looks like. And if anything's wrong on there, then contact your lenders and get those details collected. And finally, for organisations that do request bank account information from you, whether that's through statements or through open banking, make sure you're sharing relevant accounts. So make sure it covers all your income, your main bills, and the majority of day-to-day spending. I think in terms of negative spending patterns, it's difficult to sometimes break those habits. But if you can avoid doing risky things like too much overdraft usage, too many declined card payments, and also trying to avoid high value gambling. Those are kind of all good practice bits of advice that I think will help people with their application. So that's it from me. Back to you, Eloise.
Thank you for that presentation, Martin. I can certainly relate to the trend of changing the mortgage terms. As post Liz Truss, I extended my own mortgage term for exactly that reason. And looking from the Kensington perspective, when looking at affordability, we are always looking at ways to boost an applicant's affordability using regional ONS data, as well as maximising variable income types. I can confirm that both Martin and Ed's presentations are available to you in the handouts tab of the webinar today, so you can have a download and browse through at your leisure as well. I can absolutely confirm that credit complexities are on the rise, and the value of the broker because of this only continues to grow. I would now like to welcome Kensington's Head of Intermediary Sales, Jane Atkins, onto screen, who will give you the latest Kensington business update. So over to you now, Jane.
Thank you, Eloise, and I'm absolutely delighted to be able to come today to give you your business update. My name is Jane Atkins and I head up the sales team here at Kensington. I want to focus on 3 areas today. First of all, I want to say a big thank you to you, our business partners and brokers, for your support. Kensington 2025 growth strategy was to double the business volumes over 2024. And I am delighted to say, as we approach mid-year, we are on course to hit that ambitious growth. One of the success stories has been the launch towards the back end of 2024, our buy-to-let prime proposition. We listened to your feedback and you told us you wanted a simplified approach when it comes to affordability for your buy-to-let customers, including the ever-growing and important limited company SPV space. The launch of Prime has been a real game changer, offering a simplified ICR using pay rate or 5%, whichever is the higher, but combined with that great Kensington criteria. The initial launch was quite simplified. It was 5-year fixed products, including HMO and our multi-unit block. But your feedback and support has been so phenomenal that you've asked us to expand not only our range, but also our criteria. And whilst I can't give too much away, I'm really looking forward to further enhancements throughout the summer. And of course, we'll be keeping you up to date. Whilst talking about buy-to-let, our underwriting colleagues have asked me to remind you for your portfolio landlords to only include properties they hold within the entity. So what that means is only tell us about the properties those customers own in their personal names, or only tell us about those properties that are held within the customer's SPV. If you need any help and support on that, obviously reach out to your local business development manager. Talking of my underwriting colleagues, that brings me to the second point. To support you further, we've invested in recruiting an extra 22% more underwriters and 3 more underwriting managers to ensure we give you the service and direct access into our underwriting team. I hear from you when I'm out visiting you in your offices or at conferences that you really like that underwriter contact, and not all lenders offer that. So it's really, really important for us to be able to offer you that extra support and service. Turning to sales, we've also made some enhancements to our structure, promoting 3 regional sales managers working alongside your field-based BDMs, along with 3 desk-based managers to support you with pre and post application queries. We understand investing in our people is so important, which leads me on to how our sales team supports you, our third point. Service is absolutely key, and I'm delighted that we've maintained our excellent service levels, reviewing new applications in 1 to 2 days and posts on a 1-day SLA. We are averaging between 12 to 13 days on an application to offer across both our residential and buy-to-let platforms. Our BDM teams are here to help you with new inquiries, help you place cases, help you how to read credit reports, and look at your own business performance and ways on increasing your own knowledge in the specialist market. What else would you like to hear about? There's an opportunity at the end of this webinar for you to complete a feedback form, and it's really important to us to understand the feedback you require. There's also an option if you would like to attend a local BDM masterclass, understanding more about criteria and how Kensington can support you. So please take time at the end of this to complete that short survey. Thank you for listening. Thank you for your support. I'm going to hand you back to my colleague, Eloise Hall.
Thank you so much, Jane. As I'm sure you will agree, Kensington has certainly been moving in some great directions lately, and I want to thank all of you listening today for your continued support. As an intermediary-only lender, your business is hugely important to us, and I want to thank you for taking time out of your day to join us and our fabulous guests here this morning. It does now bring us to the end of our webinar, and I hope all of you listening have found it just as interesting and informative as I have. As Jane mentioned, when you exit the webinar today, you'll be presented with a short survey. So if you could let me know what you want to hear about next, that would be really appreciated. Like today's webinar, it's all been created on the back of your feedback, so it does go a long way. On screen, you'll see on screen the LinkedIn handle where you can follow us for our latest webinar and product news. The webinar today has been recorded, so if you've missed any moments or wanted to share it with your colleagues, we will make this available to you later today, or you can head over to our YouTube page where this webinar will be posted along with all of our previous sessions. I hope to see you at our next webinar in October, where we'll be discussing the growth in the buy-to-let sector and how to harness this for your business. Take care and see you soon.